Hello everyone. Today we are going to learn about accounting procedure. What is accounting procedure? Accounting procedure is the process of recording accounts, that is business transaction. Bookkeeping, recording business transaction. In the process of accounting, the first step is to record the business transactions in books of accounts. This stage is called as bookkeeping. When you record the business transactions in the books of account, that stage is to be known as bookkeeping. There are two systems under which books of accounts can be maintained. That is single entry system and double entry system. What is single entry system of bookkeeping? This is a system of bookkeeping in which the business transactions are recorded unsymmetrically and unsignificantly at the convenience of recorder. This system, although is at the convenience of a person who records transaction, has the limitations of not being able to obtain data relevant to understand the business enterprise and make decision. Means, in this system, the recorder records as he wants, unsymmetrically and unsignificantly, not in order. Double entry system of bookkeeping. Every business transaction has an impact on two accounts. For example, if goods are purchased for cash, cash account and goods account is affected. That is, if we purchase goods for cash, cash decreases and goods increases. Double entry system of bookkeeping system under which all transactions are recorded in two places. That is, if we are using double entry system, all the transactions are recorded in two places, two accounts in the books of accounts. Steps in double entry system of bookkeeping. If we are using double entry system, then we have to follow all these four steps in order to record the transaction. The following are the steps involved in recording business transaction in books of accounts under double entry system. First step, identify the accounts involved in a given transaction. The first step is to identify the accounts. If a transaction is given, we have to find out which account is involved. Second step, identify the type of accounts involved. Type of account. We have three types of accounts: personal account, real account, and nominal account. So the second step is to identify the type of accounts involved. Step 3, identify the accounting treatment. Step 4, record the transaction in relevant book. The final step is to record the transaction in journal entries or relevant subsidiary. Types of accounts. After having identified the accounts involved in each transaction, the next step is to ascertain the type of accounts involved. The following chart is given the classification of accounts. Types of account. We have two types of accounts, English system and American system. But basically we are going to follow only the English system. So English system is classified into personal accounts, real accounts, and nominal account. According to English system, accounts are classified into following three steps: personal account, real account, nominal account. So we are going to learn these three accounts in brief. Personal account. What is personal account? Personal account are accounts of person with whom the business is required to deal with. These include accounts of natural persons such as Krishna's account, Madhu's account, etc. Artificial persons such as companies, clubs, banks, etc. And accounts of representative persons such as drawings account, outstanding rent account, prepaid account, capital account, etc. So basically, in the transaction, if it is given it as Krishna's account, Madhu's account, or bank, companies, clubs, drawings account, or outstanding rent account, then it is known to be as personal account. So in simple terms, it refers to the name of the person or club or bank or name of the company. We have golden rule of personal account. The rule of the personal account is debit the receiver and credit the giver. So golden rule of personal account is debit the receiver and credit the giver. Whoever is giving, we should credit it, and whoever is receiving, we should debit it. Debit the receiver and credit the giver. Second type of account is real account. Real accounts are maintained for assets owned or possessed by the business. In other words, these are accounts of assets or properties of the business. They include tangible real accounts such as accounts of cash, furniture, building, etc., and intangible real accounts such as accounts of goodwill, patent right, etc. So, real account is nothing but the asset of the company, what the business is already having. So these, in other words, these are the accounts of assets or properties of the business. They include two types of account: intangible accounts and intangible real accounts. Tangible real accounts are cash, furniture, building, and intangible real account is goodwill, patent right, etc. And golden rule of real account is debit what comes in and credit what goes out. Whatever is coming in, we should debit it. Whatever is going out, we should credit it. The third type of account is nominal account. Nominal account are accounts where incomes and expenses are recorded. Wherever the incomes and expenses are recorded, it is to be termed as nominal account. For example, salaries account, wages account, rents account, commission received account, discount allowed account, discount received account, etc. So, here the income is commission received account and discount receive account. Expenses are salaries account, wages account, rent account, discount allowed account. We have a golden rule of nominal account. Debit all expenses and losses, credit all incomes and gains. All the expenses and losses should be debited and all the incomes and gains should be credited.